Welcome everyone. It's great to see many of you on the Zoom call, and great to hear Sarab's lesson. He's an incredible teacher, and greetings to all of you on YouTube. This is a pleasure to share some thoughts. So I'll go through a couple of slides on my outlook of the markets, share what my compliance department will allow me to share, and we'll go through the markets. And then I want to leave some time for questions at the end. I've already gotten a couple questions which we shall cover. So first quote, one of my favorites: "Without a saving faith in the future, no one would ever invest at all. To be an investor, you must be a believer in a better tomorrow." So as investors, which we all are, we're believers in a better tomorrow, even despite the COVID year that we're going through and the uncertain environment. Remember that we're investors and we're believers in a better tomorrow. Okay, so I thought this was a nice comic to kick it off. We have one investor saying, "My stocks are doing great. What else do I need to know?" And then we have someone else reading their paper and saying, bankruptcies and national debt and all of the problems that are going on in the economy. And so the question is, do stock market investors have blinders on right now, and that they think, or are they right that stock markets are at all-time highs and unemployment is also reaching all-time highs? This seems to be a big dichotomy. So what is going on here? And we'll cover some of that. So this is one of the reasons, and we've touched upon it in our lesson, is that this is year-to-date performance, and the reality is the S&P 500 is up, but all of the big tech companies, or the majority of them, are up substantially. So Amazon is the biggest performer year to date. It's up nearly 90%. But so are Apple and Netflix and Facebook and Google are just having phenomenal years. So what does that mean? It means that the majority of the stock market is either flat or down year to date, and especially sectors that are hit harder, like energy or like consumer discretionary, like cinemas, are down. But yet you have these big tech companies, which are pushing that overall average up, because the S&P 500 and the Dow is only an average of performance of those large companies. So where are we in terms of valuation? Let's see if it's cut off it on the side. So I think it's always helpful to look at long-term valuations to get a sense of where we are in terms of the cycle. And here we look at the PE ratio of the market, and we can see that the US PE ratios are above average, so they are at a pretty high level at the moment. This is a trailing PE, so this is the last 12 months of earnings, which have been, so you could say this is a COVID year of earnings, and so maybe we need to normalize the earnings, so that would put the multiple too high for the US. But even still, even taking that into account, I think it's fair to say that valuations are on the higher end, and then developed markets is Europe, and then emerging markets. And the triangle is actually the forward PE. So that probably gives you, that's the next 12 months. So that probably takes out the COVID effect. And even there, we're at high valuations, except in emerging markets, which are below their long-term average. So as an emerging market investor, I would argue that there's still value to be had, especially in international and emerging markets. And US markets are looking relatively expensive at the moment. Okay, next slide. You've probably read articles about how millennials are taking over the market, and I view this as a great thing. It's many of you, and it's our millennial audience that are signing up on Robinhood as a proxy for sort of millennial account growth. And you can see that that has dramatically taken off. Let's see, I'll use the laser pointer. It's dramatically taken off and this year, and that has had some correlation to overall market levels in terms of driving up stock prices. So I applaud the impact of millennials getting into the market. At the same time, let's be careful. I don't want millennials to get burned and have, you know, end up losing money, and so that they get burned and they don't want anything to do with the stock market going forward. So let's make sure that we're staying rational in terms of the prices we're paying and the businesses that we're investing in. And then the last, you guys know I love long-term stock market charts, but this is just to put it in overall perspective, is that in the long run, the stock market goes up by about 9% per year. The majority of that is because corporate profits go up by about that amount, plus you get about 3% in dividends. Corporate profits go up by about 6% a year, and that drives, long-term growth in the stock market. And so where are we right now? We're slightly above the long-term trend. In March, when we saw the sell-off there, we went below long-term trend, and that was, looking back, our buying opportunity, which was a good buying opportunity. But in the long run, the message here is stay in the market, stay invested, and in the long run, the stock market will go up over time. Okay, so this is my main slide. Wanting to give you guys some value, some tips in navigating this market this year. So what are some of my top ideas? I mean, I would say stay in sectors that have structural growth and pay reasonable prices. So some examples of sectors with structural growth are the shift from offline to online, which Saurabh talked about, companies like Google, Amazon, Facebook, Shopify, but so many others. Trends are being accelerated under COVID, and these companies are taking share away from their offline peers. And when you look at the whole pie of things, e-commerce percent of sales in the US is 14%. Could that go to 25%? Absolutely. And so that gives a good track record there. Google advertising share of global advertising is about 4%. Could that go to 10%? Absolutely. And so you look at these structural shifts offline to online. Another is healthcare. Pharmaceuticals is kind of is the big headline, but I would say focus on the suppliers of healthcare. You find some great businesses there. One of the first anecdotes I heard in investing is, who made the most money during the California gold rush? It was those who sold the picks and the shovels. It wasn't necessarily the people going after the gold. It was the sellers of the picks and the shovels that made the most money. And so you can apply this to pharmaceuticals, you can apply this to the oil industry. Maybe don't own the guy going for the gold, own the guy that's supplying to all of the guys that are going for the gold. We made our most money, the most money we made this year in a stock was we owned a company that went up 300%. And who was this company? This was a Malaysian company that produces gloves, rubber gloves for the healthcare industry. And what happened under this scenario is there's a massive shortage of healthcare gloves. And so they increased their capacity, but there's a shortage globally of gloves. And so then they raised their prices significantly along with the rest of the sector. And profits have gone up, stock prices shot up, it's skyrocketed. And the question would be, is like we were talking about before, is this a up and down? But we actually see this as a sustainable trend where people are more aware of germs and the value of of cleanliness, and that doctors, especially in developing countries, are more apt to use gloves going forward. So we just see this as a structural long-term trend. Consumer shifts like health and stay at home, these are powerful business models to focus on. So the second thing I would say is look for visibility, consistency, and pricing power. So don't get sucked into a stock that has hype or a trend of the day. Look for visibility, consistency, and pricing power in those businesses. The next point I would make is don't worry about noise. There's a lot of noise about politics and what happens if Biden's elected, what happens if the Democrats sweep. But remember that you're in this for the next 50 years. And so politics will come and go, parties will come and go. You want sort of long-term visibility in your investments. The next point I would say is maybe a little counterintuitive and maybe something you don't want to hear, but I would expect lower returns and I would be happy with that. The reality is valuations look relatively high at this point. And the fact is that interest rates are low. And so if you put money in a bank, you're going to get next to nothing. And interest rates, you look at the 10-year yield is below 2%. It's next to nothing. And so if I'm getting 2% risk-free, should I expect to get 15% in the stock market? I would say no over the next 5 years. I would say that's a stretch. So I would set your sights lower and be okay for sort of 8 to 10% returns. That's what history is telling us, that at this valuation level, at this point in the cycle, we should probably expect lower returns going forward. This doesn't mean pull your money out of the stock market, but it does mean when we're doing our math, I wouldn't just look for a high growth, high return business and not look at a stable, solid return business. I would be wary of taking too much risk at this point in the cycle. And so, I get the question, how much is too much? What is expensive? What is a reasonable price? I give you guys a tip here. Price to sales above 15 times is a lot. And so there are sort of tech businesses and COVID businesses that are selling above 15 times. And I would just be very hesitant of paying more than 15 times revenues or sales. And then on a PE basis, which we talk about a lot, earnings can come and go. And under COVID, a lot of companies have no earnings, but then normalized earnings are going to be higher. I would say look ahead, 3 years, look to 2022 earnings, look what normalized earnings should be for this business once they come out of COVID. And if you're paying over 50 times earnings, that is a lot. And so what I want to do for you is to make sure that you're investing in good companies and not getting caught in a 2001 tech bubble of losing 90% of your money. And so those rule of thumbs will probably keep you in the good returns businesses, great businesses with good returns, and away from sort of a bubble exploding on you. And then the last thing I would say is be greedy when others are fearful, and be fearful when others are greedy. And so when you see others being fearful, that can be your opportunity. And there's plenty of spaces where people are fearful today. And when people are very greedy, very hyped, and there's plenty of those as well today, be a little cautious, be a little careful. So I know we're at time, and I want to give some time to Q&A. So with that, I'll turn it over to you and say good luck investing. I believe in you guys. You guys are amazing. And any questions that you'll have.
Excellent. Thanks so much, James. I actually have Pranav. Pranav has a question for you today.
Yeah. So, hi, Mr. Fletcher. So my
Hi,
question.
Pranav.
So my question to you is about brick and mortar retail store bankruptcies that have been going on this year. So as we all know, many big name retailers have been shutting down this year. And the direct cause of this, at least this is what people have been saying, is the pandemic and how people aren't going shopping nearly as much anymore. And this is true. But how I see it is that this was going to happen eventually anyways because of all the technological advances we've been seeing and the rise of e-commerce. And in 10 to 15 years, there isn't even going to be any like brick and mortar retailers left. So my question is that do you think that some big retailers are still a good long-term investment, or are they all going to go down eventually?
Yeah, it's a great question. It's a tough time to be a brick and mortar retailer over the next 5 years, 5 to 10 years, let's say. And so that should be our first assumption. It'll be a tough time. My first advice to you was stick to sectors with structural growth at reasonable prices. Brick and mortar retailer is not a sector with structural growth. So that's where I'd start. I think your point is a good one, that COVID probably accelerated the trend that was going to happen anyways. Um, that being said, I think there is a place. I don't think, my personal view, I don't think e-commerce is going to be 100% of retail sales in 10 years. So it's at 14% today. Under COVID, it's probably I think it's shot up to 20% of total sales, or 25%. It probably comes down once stores open again. But I don't think it ever goes to 100%. I think it probably goes to 40, 50%. That'll be very, very painful for a lot of brick and mortar retailers when it continues to shut down stores. But I think there is place for some stores that require that in-person feel. And so niche retailers, especially, fashion retailers, or retailers where I think an omni-channel is a good place to be, where you go look at it, there's a showroom, and maybe you buy it online, maybe there's other distribution formats 20 years in the future. But I think there always will be that social aspect and that feel aspect to retail. So my personal view is I don't think it goes away completely. I think there is still good niche retailers that are doing well, but then the big box retailers will likely continue to struggle.
Yeah, because there's always going to be that social interaction
Yeah,
aspect to
yeah,
shopping and going out with your friends to the mall or whatever.
I think so. But we'll see. We'll see. So I would be cautious for sure, but yeah, I think there probably is a place for them in the long run.
Okay, thank you.
Excellent, thank you. I have Eliana who has a question.
I was just a little bit curious about, in terms of options trading, so puts and calls during the pandemic, what your thoughts are on that. Because the more I look at it, I'm like, oh my gosh, why isn't everyone doing this? Because I'm like, this is like golden, like practically no risk. I'm just wondering
Yeah.
what you think about that.
Yeah, so options trading have a couple of advantages. One, you kind of set your downside limit price implicitly when you buy the option. So you're paying a small amount, and then if it goes below the price, you just lose that small amount. And if it keeps going up, then that option is more valuable. And the other advantage that options have is they magnify your gains. So it's a leverage gain. And there's different option strategies that you can use. I think there's benefit in this environment, obviously, of volatility, and with the markets going up, options look really good right now because it controls your volatility and it gives you amplified upside to gains. So options look really good right now. When options are maybe not as necessary, or when there's not as much volatility, when the market is sort of in a steady climb, or when the market's going down, and then you can lose a lot more money on options. So I would say there is a place to it. What I personally like doing is, I'll invest, I'll not through options just by buying the equities, but I'll invest with limits. So you put a limit price on the bottom with a stop limit, and you put an entry price where you're going to buy. And that sort of creates the discipline of options, but without the risk of the leverage that options will have. So that's how I control that risk. But good question.
Thank you. I think that really cleared it up for me.
Excellent.
question.
Thank you so much. I have Sarab who is going to ask a question.
Am I allowed to ask two
Great.
questions by any chance? I just formulated a question, another one. Am I allowed to ask the second one, Christine, or?
You know what? Sure. We're going to have.
I'm fine. I'm fine on time if you guys are fine on time.
Okay, so I was gonna ask, my first question would be about the amount of corporate debt. I think the corporate debt is one of the highest, or I think the highest as a percent of GDP in the US. So do you think that the pressures due to this COVID crisis, do you think that'll cause any issues in terms of at least downgrading this large amount of corporate debt possibly to junk? Or do you think that the Fed or the government will step in to prevent the possible crisis from happening?
Yep, good question. What's your second question?
Oh, my second question was about there's just recent news that apparently certain central banks are creating projects to create their own digital currencies. I was thinking that if the area of digital currencies, Bitcoin, etc., is that a possible area of interest for investing, and how would you go about entering that space?
Oh yeah, great question, Sarab. Okay, first one on corporate debt. Yes, so corporate debt levels are high across the world, not just US, they're high in Europe, they're high in China. It is a worry that we worry about. But at the same time, we see a lot of companies like airlines being bailed out and being subsidized through COVID. And so how do we play that? My personal way, how we're investing it in our fund is we're staying away from the play of this is a highly leveraged company, but we're going to wait for the government to bail it out. I know investors that are playing that and making money because the government seems very apt to say, as Paulson said, whatever it takes, and they'll bail it out, and those companies can sort of skyrocket over the short term. Personally, I'm wary of debt at the moment. So we have a very safe portfolio in terms of balance sheets. Actually, a third of our companies are net cash and at the moment, and we have very low debt levels across our portfolio. So I'm wary. I don't want to rely on government bailouts for debt, especially, and it's the big market risk that everyone talks about, that no one knows when it will happen. But if inflation comes back and interest rates start rising, then all of this debt will have to pay much higher rates, and that can wipe out companies quick. In the moment, inflation's very low, interest rates are very low, but who knows? And that is a risk that could happen over the next 3 years. There's a lot of money going into the system, and if it does, I don't want our portfolio to be in trouble of rising interest rates. So I'm personally staying away from leverage companies at the moment. Second question on cryptocurrencies and government's involvement on cryptocurrencies. Yes, so as you know, I'm here in Hong Kong, and the big talk recently is that China is developing a cryptocurrency, and they are starting to sponsor it within state-owned banks. If that becomes mainstream, so you currently have a system where the global reserve is the US dollar. So all commodities are priced in US dollars, and the global reserves of central banks around the world is in dollars. And if there was a crack in that assumption, it would be cryptocurrencies, if cryptocurrencies can take off. And I think that's why China is investing some into cryptocurrencies, in their own cryptocurrency. It wouldn't be Bitcoin, but because if that took off, they could get away from the dollar reserve, and that would be very powerful for China. So it's not necessarily impacting our portfolio, our stock portfolio. So, Bitcoin for me is very speculative, given that the demand supply is not driven by typical demand supply that I'm used to as sort of a fundamental investor. It's more sort of speculation of demand supply. But the trends of blockchain and cryptocurrencies, especially if countries adopt them, could be, we'll see. It's something to monitor, and that would obviously be very negative for the US dollar if cryptocurrencies were able to gain ground within government acceptance. As of now, the regulation is so tough against cryptocurrencies that it's tough for them to become mainstream.
Excellent, thanks for that. I have Gabriel who has a question for you.
Hey, Gabriel.
Hey, let me try to find it because like there's so many people that type that I can't like find it anymore. Okay, I found it. Sorry.
Yeah, you guys have a lot of good chat questions. Appreciate all of the chat.
Okay, so my question was, how do you believe the automotive industry is going to respond to like COVID? Because I've noticed in the stock reports that a lot of stocks are like not being affected as badly, but like some stocks like Tesla are really volatile. But at the same time, like not that many people are driving. So how do you think that companies will be affected?
Yeah, auto industry is an interesting one, and I knew Tesla was going to come up today because Tesla's just been such a home run this year, and yeah, such a beneficiary of COVID and this environment that we're in. You know, it's similar to the discussion we had about e-commerce. So e-commerce is at 14% today. You know, where is it going to be in the long run? Maybe 40, 50%. And so that is a huge runway of growth ahead for e-commerce. And obviously Amazon is benefiting from it. Shopify is benefiting from it. And then, you know, similar thing for EVs. EVs are, you know, 2% of sales today. And where will they go over the next 10 to 20 years? They can go to 20%, 40%, 100%. And so that's sort of your assumption of how big they'll get, but they will get much bigger. And so if you have a Ford or a Chrysler or a VW, and you're trying to forecast their profits and their cash flows 10 years from now, and then you're looking at their models and they're behind on their EVs, you at least need to model it in and sort of take account of how much lower those profits could be in the future. And so that's why those stocks are trading very cheap at like 7 times PE ratios, because the market is worried that their sales that are 100 today could be 50 in the next 5 or 10 years. And then I think the second part of your question was, what is the impact on overall driving industry under COVID? One of the tricks is to look at companies that are, or look at countries that are into COVID and then come out of COVID to gain some insights. And China is the one to watch there because they went in, they had their COVID hit, and then they're coming out of it, and people aren't even wearing masks in China anymore because the cases are 0. And so what we see in China is that people come back to cars in a big way after COVID, and even during COVID, because people are worried about taking the subway and they're worried about taking public transportation. And so a lot more people are actually buying cars. And so I would say the impact, at least in the medium term on the auto industry, is positive, is that more people are more aware of not taking public transport. And then you combine that with EVs, and you see why Tesla's done so well this year.
Thank you, Mr. Fletcher. I know, yeah, talking about China, I noticed really recently that like the day that Tesla announced that they were going to be like starting factory production in China, the stock increased a lot. That was the day that it increased the most for my portfolio. It was really cool.
Ah, good. Well, congrats for you for owning Tesla. You're a rich man if you put a good amount of money into Tesla. Absolutely. local production in China for Tesla is a game changer. And what they're talking about, what they talked about during their battery day is using that China production to then export to Southeast Asia and other Asian countries. And so having sort of low cost production in China and be able to export it to other Asian countries is very powerful. I'll make a joke. We live in Hong Kong, and Hong Kong is a wealthy country. But my wife made a joke the other day. She said, "I don't want to get a Tesla. They're too mainstream." So she called Tesla a mainstream car. Why? Because everyone has a Tesla in Hong Kong. I mean, it's like a third of cars on the road are Teslas, and they're mainstream in Hong Kong. And so Asians love Teslas. There's no doubt in my mind that Tesla will have a huge market in China. And so that production facility there is a game changer. And I think as Teslas become more affordable over time, they will continue to sell more. I think the stock is expensive. And so I would be personally hesitant at Tesla stock at this price. You need to do the 10-year numbers and factor in sort of your expectations, not just by sort of the stock price trend, but it's a powerful business that they have for sure.
Mr. Fletcher, sorry, Miss Tobin. But since we keep talking about like EVs and it like ties into like niche markets, do you think that like niche markets like luxury and EVs and those sorts of markets are gonna be less affected by COVID since it's more like they've been established for so long?
Yes. And that's actually a good point to be aware of, is that luxury has done well through COVID. New trends have done well through COVID. So you need to think 2 years out, when we have a vaccine and when COVID is sort of diminished, those luxury sectors probably won't be as in demand from investors, the scarcity value of a business that's able to hold up during COVID, as maybe some of the recovery sectors. So be aware of that in sort of the market cycles, is that luxury's done very well. Niche sectors have done very well during COVID, but those may cool off during sort of normalization. So that's a good point. It's something to be aware of.
Thank you.
Yep.
Thank you. Jack Swisher, you had a question for James.
Yeah, so it's crazy, but you basically answered my entire question in the discussion we just had.
Let's hear it.
Yeah, so I was gonna ask about Tesla in China and your thoughts and how it's gonna grow in China and stuff like that. And you said, which I'm very happy about because I'm also an investor in Tesla, that they're gonna be really popular, and they already are to some extent. But I've heard that some people fear that because China might not want a intelligent network of cars all throughout China accessing internet data and data on people, that China is going to restrict Tesla and instead prop up other EV companies like NIO and other competitors. So
yeah, that's a great point to add to it, is that China's very sensitive of data, and the automated driving uses a lot of data. So what will Tesla's impact be there? You mentioned NIO. NIO is the Tesla version of China. I don't think NIO cars look nearly as good as Tesla. And I don't think they have the same brand, as I talk to Chinese citizens, as Tesla does. But NIO's stock has done phenomenal as well, and they're nowhere near profitable. It's a good point. It's a good point. I would, investing in China, as you know, this is what I do for a living. You need to, the adage in the US is don't fight the Fed. In China, don't fight information, and the governments need to control that information. So, for me, it was kind of a no-brainer to invest in Alibaba or Tencent or the leading internet companies that are on good terms with regulators, and there's no way that a Western company is going to be able to come in, because that information and that relationship is so important to have with the Chinese regulators. I don't think, but at the same time, on the other side, you have Chinese companies, you have multinational companies with premium brands. Luxury sells incredibly well in China from France or US. Chinese value brands and they value Western brands. And so Tesla is kind of right in between, right? It's the Western brand, but it does have some information that China's going to favor their local champions above Western companies. But I would say overall Tesla should be fine. If you look at other automakers in China, China has a good track record of doing a JV with Hyundai or Toyota, having a Chinese partner be part of that JV, and then those companies can sell and do well in China and even grow above the local market players. So as long as Tesla will probably need to have a strong Chinese partner at some point that has a good relationship with the government, and as long as they can navigate that okay, they'll probably be okay. But it's a good point. It's a good point. And maybe in your estimates of Tesla China sales, maybe you put a discount and put a probability that may be zero. And does that change your investment decision?
Great, thanks. James, do you have time for one last question from Luke?
Yeah, sure.
Perfect. Go ahead, Luke.
Hi, Mr. Fletcher. I was
Hi, Luke.
wondering if you made any investments where the thesis directly or indirectly involved climate change or ESG factors, and generally as an emerging markets manager, how are ESG factors sort of considered?
Yes. Great question, Luke. And so I work for, I manage a $1 billion portfolio for the APG Asset Management, which is the largest pension fund in Europe, which is the pension fund of the Netherlands. Netherlands, as you know, are extremely forward-looking on ESG and sustainability and climate change. And I would say, as a result, we integrate ESG factors into our process as much, if not more, than any other sort of investment fund out there. So it's highly embedded into our process. Yeah, we could probably talk hours about how we embed it, but we do a 50-point scorecard of governance, social factors, and environmental factors. It takes us about 10 hours per company to go through the ESG scorecards and look at the board backgrounds, look at the people backgrounds, look at the social factors, the employee pay, the compensation, the employee reviews, and then the environmental factors, their metrics of carbon, their metrics of waste management, and their disclosures, their mission, their centricity. I mean, all of this takes us a long time that we go through for every company we invest in. What I would say, as sort of to answer your question, one of the points of ESG is UN sustainability companies called SDIs, Sustainable Development Initiatives, and these are companies that fit into the UN development goals, and these are healthcare companies or companies that alleviate poverty or reduce waste around the world. Our portfolio currently has 25% of our portfolio in SDI companies, and those companies this year have been our best performers by far. And so actually we've added a lot of alpha. It's helped us beat the market by investing in these SDI companies. So companies that, Riverstone we talked about in Malaysia that makes rubber gloves, that's related to healthcare. Our healthcare companies have done phenomenally. Our waste management companies, so we own a couple waste management companies in Korea and Taiwan, have done phenomenally. So those trends are long-term secular trends that you can do well. The caveat is you don't want to invest in a company just because they're an SDI. So just because they are a renewables company, that can't be your only reason to invest. If they're not profitable, if they're not growing, if they don't have a good management team, then this won't be a good investment. And a lot of investors got burned in solar, for example. They went in big into solar. Solar is going to grow, which it has, but the solar companies ended up being terrible investments. And so you need to be careful about separating the long-term trend versus the company. But that being said, when you can find great companies in those buckets, in those SDI buckets, you can make a lot of money because it's a long-term secular trend and you can own the right businesses in those trends. So great question, Luke, and it's something close to my heart there.
Thanks so much. Great answer. Wow.
All right, well, we might have some last minute questions from anyone who still had a question and didn't message me. So if you still have a question for James before he leaves, now's the time. Anyone?
I
Yeah,
appreciate all of these questions. You guys are on the ball. Holy cow.
I had a question about merger and acquisition deal flow. So, as we know, before COVID hit us, M&A deal flow was at an all-time high, or it was really high. But now this year it's been down because of the pandemic, and corporate activity hasn't really been as high as it was before. So how long do you think it'll take for it to go back to normal and the heights it was at before?
Yeah, good question. I think in this environment that we've been in for the past 5 years, and which we will probably be in for the next couple of years, which is interest rates are very low, so capital is very cheap. Companies are for the most part generating cash and are remaining profitable. And then growth is very low. So growth is very scarce in the market because there's very little global growth. As we stay in this environment, that is the perfect recipe for deal flow, because a company has cash, they're not growing, but investors want them to grow, and they can get almost free capital from banks. So what do? They go buy growth, and you go buy companies to get growth. And so I would expect that if we stay in low interest rates, with access to capital, low growth, and still profitable cash generative businesses, that we will continue to see M&A deal flow. And we've seen it. I mean, venture capital industry, private equity industry is starting to pick up if you look in these past couple months. And so, there's a number of VC big deals that are getting done. There's flows, and I would anticipate that there will still be a good amount of deal flow as long as capital's free and investors want growth, but there's no growth to be had. Then you'll start buying growth.
There's a lot of arbitrage opportunities in today's economic scene.
Yeah.
Excellent. Thanks so much, James. Thank you for your time today. I really appreciate you taking out the time of your morning to be here with us. We also had some students here from Malaysia and Hong Kong today. So it was great that you guys got up early and were able to join us. And I want to thank Leon. Leon is one of our YIS ambassadors. He's been answering questions in the chat and posting links for students to do some more research. So thank you so much.
Thanks, Leon.
All right, you guys. Well, this concludes our discussion session for today. Tune in next week, same time, same place, on our Zoom video, and I'll see you guys next week.
Bye, guys. Great
Bye.
questions.
Thank you.
Thank you.
You're amazing.
Bye.
You.
Thanks so much. Bye-bye.
Thank you.